people think, oh, Jason knows where the market's going to go. And I get people saying, where's gold going to go today? I'm long gold. What should I do? And I'm like, I have no idea. And if gold's in a bull trend, it'll probably go up, but I can't give you a time period for that. I don't have a crystal ball. I don't know where gold's going to be at 4 p.m. today. Just like Warren Buffett doesn't know where Apple stock is going to be in 3 months' time. He hasn't got a clue. He's not in Apple stock because he thinks he's going to a specific price in a specific period of time. So no, I don't know any better than anyone else. I can give you an educated guess on where the market could go today. But my strategy is all about...
Welcome back to the Unpacking the Markets podcast. Now, before we kick off, can I please ask you to subscribe to this channel so that we can continue to grow and help traders worldwide. Let's get into it. You've had a really interesting career, right? You started in the brokerage business and then you quickly moved into market making. Now, that was in the 90s. So is there anything that you learned in that period that still applies in your trading today?
Yeah, the key thing that I learned on the trading floor was risk management. You had to really focus on it almost more than I do now. What I'm trying to say is now you can automate so much. Digital trading, of course, you can just, here's my entry point, here's my stop loss, here's my target, boom, go away for the day, wait and see how the trade plays out. Well, obviously that wasn't the case when you're on the trading floor. I was a market maker, so I was standing in the middle of the pit and I was waiting for business to come to me. I was sort of, what's the word? I wasn't like proactive like you are on a screen where you're actually looking for your entry point. Here's my stop loss, here's my target, how am I going to structure the trade? It was completely different. I'm standing there, market moves around. I might have deltas and gammas on my options position, which I'll be hedging. Otherwise, I'm pretty much just standing there and waiting for the brokers to come into the pit with their orders. So therefore, when markets are moving around, you have to be, you're making prices, you're trading, you're hedging, and then you're also watching your position to see when you need to re-hedge or, so yeah, it was different. But I don't know, you're almost more aware of your risk when I was on the trading floor market making. So that was what I really brought to digital trading. And now, of course, we're all in that mindset where, you only risk 1 or 2% per trade and you have your stop loss. And of course, I'm looking at charts to decide where I want my stop loss and my targets, which of course I didn't have on the floor. So in that way, it's much more precise.
Yeah. So, trading probably quite large volume without a stop loss, I guess, is what you were doing at that time. So I guess it was some kind of stomach churning swings in P&L maybe.
Yeah, it was manual stop losses in your mind. I mean, to be honest with you, my stop losses were when I can't take any more pain, I'll hedge the position or get out. I didn't really have a number in my mind. So it wasn't the most disciplined trading, I suppose, but you certainly understood risk because I had big P&L swings. I mean, these days my P&L swings are small and I don't even trade full time anymore, if I'm not honest with you. But in those days, I could easily have a 50 grand, £100,000 P&L swing on a daily basis, and that was 30 years ago. I mean, it's quite a lot of money now, but it was a hell of a lot of money then. You could buy an apartment with that. So it was very stressful.
Yeah. Yeah. And you mentioned, when I say you were a trader, you famously were a trader in the Open Outcry hits, right? Which are like, I wouldn't say, I don't know what the right word is, but maybe notoriously known in the industry. So what was it like a day in that as a trader in that time?
Oh, it was absolutely fabulous. I just feel so lucky, so privileged to have been in my early 20s. I happened to, I was lucky enough to be born in London. I wanted to get into that, into the financial markets. And I wasn't really aware of open outcry markets. My father was a trader and I knew I wanted to trade. It fascinated me. Financial markets fascinated me. So anyway, I was lucky enough to end up on the London traded option market, which was on the stock exchange. And then I fairly quickly moved over to LIFFE, the London International Financial Futures Exchange. And it was just absolutely bonkers. From the beginning of the day, the bell goes bang and everyone's just shouting and screaming. Everyone's in a brightly colored jacket. You're using hand signals to trade because the volume of noise is, you couldn't, when it's really busy, you couldn't have a conversation or you couldn't say, excuse me, can I buy some of those? So you're using hand signals to trade and to confirm the trade. It was just the most exciting environment. It really was.
Do you still remember some of those hand signals?
Oh, I can still do them. It's really weird.
Really?
Yeah, I was in a podcast about 9 months ago, and the interviewer was asking me, and I started doing the hand signals. I was like, oh wow, I didn't actually realize I could still do these so well. It's like riding a bike. You just remember them.
Can you give me an example of one? Because I have no idea actually what. Yeah.
Sure. Okay, so I'll give you a quick run through. So if you were buying, it was palm facing towards you. Selling is palm facing out, because it's like you're pushing away and pulling in. So if I was, if someone would come into the pit, they would come in and they would say, I want to trade the 100 calls or something. So that would be the one. Can you see my finger? Move back.
Yep.
The 100 calls. And they would say, what's the size? So I would say 50, 52, 4. That would be my price. I'm 52 bid, I'm 54 offered, and I'm there in 100. Wow. Size was on the face. So if he sold me, he might say, well, I'll sell you 50. Size on the face. So I'd say, okay, I buy 50, I pay 52 for 50. And then you would do checking and then he would go, yeah, confirmed. So that was a basic trade, the way you would do. There was a lot more. There was hand signals even for the companies, which some were a bit obscene, so I won't do them. But so you'd make up hand signals for the different companies so that you could confirm who you traded with, all that kind of thing. And when I first went on the floor, I was like, oh my, I will never be able to learn this. These guys were so quick with their hand signals. And the people reading them were so quick. They could read the hand signals so quickly. I thought, I'm never going to be able to do this. But, it just does eventually become natural.
Yeah, I guess there wasn't someone kind of nursing your learning very lightly. It sounds like a very intense environment, but I guess probably the perfect environment if you can swim for someone starting off at 19 or 20, right? Were you just learning all the time about markets and just I guess the job?
Yeah, I guess. Yeah, that's actually a really good point, because I was working for a market making company. It was a privately owned market making company. It wasn't like a bank. So they financed me. And then, you're in the financial markets from 7 in the morning till 5 in the evening, and that's it. You're just immersed in financial markets. You're watching all the news coming out. You're watching all the order flow, what the banks are doing. You're talking to people constantly about options and futures and markets and bonds and interest rates and stock markets. So, yeah, it's a good point. That's actually a really good point, because compared to now, if you're a trader, even if you've got a prop deal with one of the funded accounts, if you've got a funded trader account, you're really on your own. There's not really anywhere you can talk to. You're not talking to people all day about it. You might be watching videos and stuff, but you're not interacting on that level. So it's actually a really good point. It was really immersive for me at such a young age to be able to do that. And yeah, it is real sink or swim. You're thrown in the pit, and the other guys in the pit, they're not interested in trying to help your career. They're interested in ripping money out of you. And that is the way the game is played. And if you're not prepared to play that game, you are going to lose real quick. And I would say 10-20% of people that went on the floor made it.
Really?
Survived. You'd see people coming and going constantly.
Wow. Yeah, because you touched on the language of using your hands, but when I was on the trading floor, not trading, as shadowing a guy in sales, it immediately struck me that even now there's a different language, which is probably much easier than what you learned. But the likes of what FX pairs are called, like the likes of dollar yen or Aussie or cable, and someone going up on a microphone and just shouting these things and getting prices back still to this day. I always found it quite fascinating, right? But so you in that period, you must have gone through some of those big crisis moments, maybe in the 90s, or major market moments. Is there any ones that you remember or stick out in your memory particularly?
Yeah, it was a very volatile period, which I guess I was also lucky to live through, because it did teach me a lot of lessons. I started in April 1987. And then 6 months later, in October 1987, we had the biggest stock market crash for 58 years. Welcome to your stock market career. I didn't, I didn't really understand what was going on. It was just absolute pandemonium. And the stock market dropped something like 50% that week. So I was like, oh, okay, this is obviously not normal. It was very exciting. So that was the first thing. And that actually, funnily enough, that was a blessing for me. I thought that was the end of my career because I lost my job. Volumes collapsed. And there was a bunch of us that got fired from the bank in December, 3 months later. And it was actually really touching because the guy that fired us was in tears. He was so upset that he had to let us go. He was such a nice fella. Anyway, it ended up being a blessing for me because I ended up getting a job as a market maker about a trainee market maker about 2 or 3 months later. So that put me into the actual trading world. Otherwise, I'd have stayed in the broking world. And then in 1992, we had what was called the ERM crisis. There was an exchange rate mechanism in place by the then chancellor, who was, I think, Norman Lamont. Anyway, the idea was that the pound was tied to the Deutschmark because they had their inflation situation under control, and historically we hadn't. Anyway, so our currency was pegged to the Deutschmark. What it led to was the UK having unsustainably high interest rates because we were at a different part of the economic cycle. And eventually, it was George Soros that's probably would jog people's minds. He famously broke the Bank of England when it is said that he forced the Bank of England to leave the exchange rate mechanism. Anyway, we did. The pound collapsed, interest rates collapsed. And on that week, when it was crazy, when the government was trying to defend the pound and ramping up interest rates, I made like £1 million in 4 days, and I was like 24 years old. So that was crazy. But then in 1998, there was the Russian debt crisis, and I lost a fortune. So it was swings and roundabouts, really,
Yeah. I mean, what was it like getting that kind of success earlier in your career?
You would think, well, it was amazing because obviously that was a huge sum of money to me. And I was smart enough to put it into property and in investment. Well, actually, to be fair, I did buy 2 Ferraris. But then after a couple of years, I realized, hang on, this is a bit silly. You need to get into property. So I quickly got control of myself and started building a property business. But the problem is it was such a lot of money at such an early age. I didn't become materialistic, but I did go into, when I was then trading, I wasn't bothered about making £1,000, £5,000. I was like, I wanted to make big 5-figure numbers, big 6-figure numbers constantly. So I was swinging the bat, taking big risks all the time. And there was, for 2 or 3 years, I really don't think I made much money at all. So I would say to people, actually, when you have an early success, because also people, when they start to trade, some people just get lucky and they do make a lot of money early on when they start trading, and they think they know it all. Sometimes it can be a bad thing, and it can be a big setback because you think you know it all and you really don't.
Yeah. Now, I've much milder example of success when I started trading, as in I made like, a couple of £100 relative to what I had invested. But it was a terrible start for me. Anyway, I ended up kind of similarly, having that kind of know-it-all mindset, which really set me back, because I was always constantly looking for some complex trick or thing or, secret that was going to, skyrocket profits, and not really attesting to the trodden path of just consistency and finding an edge and applying that every day, right? So yeah, it can take you off the wrong track completely, I think. But
I'll be honest with you, that's been a problem for me throughout my career. I'm greedy, and I can't be bothered to sit there and make £100, £100, and finish the day with £500 or whatever it might be, whatever the number is. And I still have times when I'm going to average, I'm going to do more. I often don't practice what I preach. That's what I'm saying. I get greedy and I get careless. I know exactly what to do, and I can teach anyone how to trade. But do what's the saying? Do as I say, not as I do, or something. I'll be honest. I have bouts of indiscipline where I'm just gambling and I'm thinking, "Oh, what are you doing? Come on, get a grip."
Yeah, but I think that's why, and we'll get into your process a little bit later, but that's why I think it sounds like your process is a perfect fit for that, the kind of set and forget type mindset, that you're not always watching things and that things are set and moving when you're not there, so that you're not really involved, right?
Yeah, I kind of that evolved partly because I don't trust myself to be disciplined, and if I spend too much time in front of the screen, we all get silly. When you trade watch, I just don't think it's the right thing to do. You're making rash decisions, spontaneous decisions, unplanned decisions. So yeah, it was really a case of not trusting myself to sit in front of the screen. And then also most of my subscribers, they're not full-time traders. They have jobs or businesses. So they also can't sit in front of the screen all day. And I advise them not to anyway.
Yeah. Yeah. And I interviewed Rob Carver before this session, and Rob's a systematic trader, or that's his full-time, like as in no touch systematic trading. He recommends starting with the system, which again to a discretionary trader can seem like a challenge, but actually I think it's a great place to start because you have a little bit of hands off. And I appreciate your honesty. It's not everyone is as honest as you, saying, we all get greedy, we all get fearful, but it takes a lot of discipline to not act on that, I think. So
well, I mean, the problem with me is I don't know how I ended up being a trader, because I'm impulsive, I'm emotional, I'm all the things that I shouldn't be. And this is why I have to have these processes in place to stop myself from losing control of myself.
Yeah. Well, I think I have a question later on that challenges the fact that you're impulsive and undisciplined, because in my research, I've come across quite a lot of discipline in your career and just meeting deadlines, timelines. So actually, to get into it now, I read that you never missed producing your analysis in plus 15 years every day, right? So you call yourself a lazy trader, but I find it hard to believe, right?
Yeah, actually, I'm quite proud of that. I'm very disciplined insofar as I get my stuff done. So even if I go on holiday, and I travel a lot, but I will always get up and I will always do my analysis. It's kind of an addiction. I can't imagine not doing it. I really enjoy that process. So even if I'm thinking, I'm not going to trade for a month, I still enjoy getting up and I still enjoy trying to beat the markets. Can I get the low of the day in gold or whatever it might be? Yeah, I'm very ADHD, and I think that in me makes me have to do. If I've got a list of things to do, I actually have to do it right now. I can't go off and sit by the pool for an hour and think, I'll do it later. I have this compulsion to do it. So that part of my life is very disciplined. All my businesses run very, very smoothly. And as long as I stick to my processes with my trading, that also goes well, very well.
Yeah, very good.
Actually, sorry, can I just say something? Because you talked about being a lazy trader, and trading is really odd, because it is a job that can reward you for doing less. It's so bizarre. Obviously we learn that the harder you work, the better you do, and the more money you make and whatever else. But trading, it's just this odd thing where actually time away from the market can be important. Not sitting in front of the screen, not trade watching, not watching your P&L do that. It can that can be rewarding, just sitting on your hands and waiting for the right opportunity. I've seen and heard of traders who can go for days without trading. They have one setup, they wait for it, and when it happens, they're in. But they can actually sit and just wait for that setup, and I think that's phenomenal, because that isn't me.
Yeah. Well, I think when you're away from markets, you think that I'm away and now I'm not actively making money. But I think even personally, I forget sometimes you can also lose money when you're actively engaging in markets. So you think, oh, well, I could be earning alpha. It's like, well, you could also be taking silly setups that haven't got an edge, and then you're just going backwards. And you end up at the end of the week down 2%, thinking I shouldn't have taken 3 or 4 of those trades, or one of those trades, depending. Yeah.
Exactly. You shouldn't. You wouldn't have been in those trades if you'd not been just staring at the screen. It's FOMO, isn't it? It's the FOMO thing. I'm sitting in front of a screen. The markets are moving. Why am I not making money? Why am I not in a position?
Just talking to you, you have obviously from your kind of plus 35-year career, a lot of market knowledge, macro knowledge, and knowledge of what's going on in the world. But I know your process is very technical. So does that, I guess, your views on the world and following markets, like the news and events, does that ever impact your trading?
It does, for sure. You have to be aware of what's going on in the market. You have to be aware of, the geopolitical situation and the macroeconomic situation as well. Of course, right now, US economy is slowing. Interest rates cuts are looking more and more likely. So you have to have that in mind. I can give you an example. On Friday, we had the PPI number out. On Thursday, we had the CPI number out. The CPI number was weaker than expected, so the dollar sank and gold went through the roof. And so I had a view that if the PPI number comes out strong and gold dips a little, the dollar strengthens a little, I'll take advantage of that and I'll sell the dollar and I'll buy gold, because I don't think that will be a sustainable move. So although I'm purely technical, that was my strategy on Friday, and I found a good support level in gold, a good resistance level in the dollar, and it worked because the PPI number did actually trigger a bit of a move down in gold and a move up in the dollar. I managed to catch the low of the day in gold, so I do have that in the back of my mind. I wouldn't base a trade on the macroeconomic situation, but I certainly, you have to be aware of everything, don't you?
Yeah, I really like that, and kind of, I guess, using being aware of it first, knowing there'll be volatility and using that in your favor, but kind of as a supplement to your technical analysis seems really smart, because I guess you can't ignore it. I mean, I tried, I guess when I started trading, I had no real awareness of these big kind of events, or I call them in a post recently, kind of landmines that can just blow up a position if it's tier one data, and you're not aware of it, and all of a sudden you have a great trend following bounce setup, and then it just gets ran through the floor, and you're thinking, what's happening? And it was one of those gaps or blanks that when you fill in, you're like, okay, at least I can now maybe walk around them, at least, or as you did, use them to your advantage.
Yeah, well, until fairly recently, until several months ago, I didn't actually include any macroeconomic or fundamental information to my subscribers. I just assumed they were following the news and they knew what they were doing. You make assumptions when you've been doing something for many decades. And then when I'm talking to people, they're like, what does PPI mean? What does CPI mean? What will it do? What does that unemployment number do? So it's like, oh, okay, you need it explained. Fair enough. So now as part of my service, I explain what's going on and what the outcome of a data release might be, how it could move the dollar, gold, stock markets, whatever.
Yeah. And you learned a lot of that through your institutional career. But a lot of traders, I guess, it's not their main job, or they might have a job and trade on the side. Do you think having an institutional career is important to being a successful trader?
It obviously helps. I don't think it's something that you need to do now. I managed to get an economics A level just before I started on the floor. So that gave me a really good basic understanding of macroeconomics. And then being immersed in that world, you understand how the data will move the markets. But I think it's something that's quite easy to learn these days, because there's just so much information out there on YouTube. And, in my day, obviously, the internet didn't even really exist, let alone YouTube. So me trying to find resources to understand economics or technical analysis or trading psychology or trading discipline, it was really a struggle to even be aware of those things. I mean, trading psychology didn't come into anything in the 1990s. You struggled with mental health because you're just taking huge risks every day, but you didn't go in and say to one of your colleagues, oh God, I'm having a really tough time. I can't sleep. And, they'd be like, what? Shut up and get in the pit, you idiot. What are you talking about your emotions for? It didn't happen in that decade. This is a relatively new thing from my perspective, and it's a good thing. But mental health to me wasn't even a thing. You just had stress and you dealt with it, and that was it. If you don't like it, get out, find another job.
Yeah, maybe we should bring back a modern pit for to build mental resilience these days, to toughen up my generation, maybe. Yeah.
Maybe.
But I want to shift to your trading process, because it's come up a little bit, and I really like it because I think it's a really nice place to start for someone, just to get the mindset right, and then, it's a great place to continue as well. But just when you come to trading, I feel like expectations are everywhere. You're not sure how it's supposed to work, and I really think yours is how it's supposed to work. So can you give a quick overview of, I guess, your trading process or signals, and then why you chose that process specifically.
Okay, well, it's dead simple. I, as far as my subscribers are concerned, I live in Thailand, so I'm 6 or 7 hours ahead of Europe, which is quite handy. So I can take it slow. I can do my two hours analysis, get all my information posted to my subscribers before, and then by the time they wake up, it's already done. So I believe that, well, from my experience, I know it's much better to do my analysis when I'm not involved in a position, because you just can't help yourself. If you've got a lot of positions on overnight, you know that you're looking for reasons to hold those positions. You're not being objective. So I try and do that, and then I create a spreadsheet of the best trade ideas that I can find. Dead simple. I'm a trend follower. I used to not be a trend follower. I used to see the market go up and I think, oh, it must have gone up too much by now. It must come down. I'd sell it, and I just lost and lost and lost. And eventually I realized, okay, I actually need to just go with the trend, because the trend will last way longer than you think it will. Try and be long in a bull trend, try and be short in a bear trend, whether that's buying at a support level in a bull trend or buying on a break above the previous high or a resistance level, whatever it is, the trigger to help you get in. I set my stop. I use technical analysis to decide where my stop loss is going to be. And I use technicals to decide where my target's going to be. Obviously, risk reward, risk 1 to make 2 or whatever it is. That's fairly standard. Risk 1%, maybe maximum 2% on a trade, so that when things go horribly wrong and you have a string of 5 or 6 losses, happens to all of us, even me, you're only down 5 or 6%, you're not down 20%. You can sleep at night, you can wake up the next morning and think, it's all right, I can get this back in 2 or 3 trades. When you're down 20%, you're like, wow, I need to now make, 25% to get it back. And that's a big challenge, and it's demoralizing. So, sorry.
I was going to say, but it sounds really sustainable. Just the kind of part you mentioned, where it's analysis done in the morning or on a weekend, level set in the morning, and then you kind of walk away, I guess, and just let that work.
Yeah, I really do. Most of my trades, an average trade I'd be risking maybe 25 pips trying to make. My first target might be 35 pip profit. The next target might be 60 pip profit. If I can get out of half of it, some of it, the first target, and the rest of it, second target, I'm happy. Obviously, if you've got that risk reward ratio and only 50% of your trades work, you're doing fine. You're making money. I'm happy to say that more than 50% of my trades work, so that's quite good. Yeah, it's for me. I actually did a I called it my free 5-day challenge. It's been out for about a year now. And I focus on what I call mental capital, because we're all trying to preserve financial capital, because obviously if you don't have money in your account, you can't trade. But I have another concept which I call mental capital, because even if you've got money in your account, if you haven't got control of your thoughts and your emotions and your processes, you're going to damage yourself. When you sustain a big loss, I say that you've sustained a big loss of mental capital as well, because your confidence is blown. You're not going to be sticking rigidly to your processes like you would do if you were feeling confident. So, there's 2 aspects of it, really. The mental side is such a strong thing. And as I said earlier, it's only something I've really come to terms with by talking to my subscribers and followers in recent years. I've really come to realize how important it is as a new trader.
Like I said, yeah, having done trading as your job, when I've spoken to former institutional traders, it's some of them, it's not a huge thing, because that was their job. There was kind of almost no room for it, or they had done, maybe like you, had sustained such big swings in P&L or seen such big numbers move that it just kind of falls off them a little bit. And then newer traders come in and think, as you said, a 25 pip move, and it's like, oh no, is that too much for me? And then they kind of fall off the path.
Yeah, the thing about institutional traders is you've got such a huge support network, and it's not your money. And if you sustain a big, and you've got risk managers there who are saying, hey, ease up on that, or there's a lot that is done for you. You're handling huge sums of money, and this isn't me speaking from experience, because I never worked for a bank. I only ever worked for a guy who financed me privately, a super wealthy guy, and he certainly had his rules in place, but it was still I got a very large percentage of what I did. I was on a sort of a funded trader deal. But I know that talking to bank traders, they can be phenomenally successful in a bank, but moving on to then they say, right, I'm done with that. I want to trade for myself. The transition can be really tough because that whole support network isn't there, and they don't realize until they're sitting in front of a screen with 10 grand in their account trying to trade their own money. And they're like, wow, I'm really on my own here.
Yeah, very true, actually. I mean, you could kind of, there's nothing stopping you from really making terrible decisions versus in an institution where you could have as you said, a risk manager or someone that will stop you, or a limit for the day. I mean, I like to use, say, daily stop loss limits or weekly stop loss limits, which I never used in the beginning because I was too busy thinking I was going to make so much money. But in reality, there are weeks where you lose money. Everyone does. So it happened to me a couple of weeks ago where I think I hit 3%, 4% loss on free capital, which is about 25-30% of my overall capital. So it's a smaller sum of my total capital, but I had to just on Wednesday say, right, I'm going to walk away now for the week. And it was probably the first time I ever did it. Before, I used to just come back and just be like, oh, I'll just take this trade here or there. But I said, right, as you said, to preserve that mental capital, you do have to kind of walk away and give yourself a little bit of a gap, because market's going to open on Monday, and there will be another day to trade.
The markets are always there. So did you feel that was a really good thing? Did you manage to get your head together and feel more confident when you started again?
Yes. Yeah. It gave me time to focus a little bit more on preparation and just be a little bit more choosy with the setups I was taking. And then very luckily, I was short New Zealand yen into the intervention, which is always a nice.
Fantastic.
I mean, you never know what's going to happen. It was honestly, CPI came out on Thursday, and I was thinking, I walked away. I was like, whatever, this shouldn't have a major impact on this position. And then I opened back up my laptop, and I was thinking, it's down.
Where's all this money come from?
Yeah. It's like, this is great, because I had losses from the previous week, which is, again, over time net, you do okay. But again, you have to be able to kind of ride with the punches a little bit, because I didn't know that was going to happen last week, but I just needed to get out of last week without, taking a lighter to my P&L or to my capital. Right. So, but yeah, on the topic of your process and your signals, you talk about low risk opportunities and sending out kind of across multiple markets a low risk trade. So how do you kind of find low risk opportunities for your clients?
Okay, so as I say, number one rule, trend following. I only ever buy in a bull trend. I only ever sell in a bear trend. So I'm looking for support levels in a bull trend. Dead simple. I use Fibonacci. I use slow stochastics. So if the slow stochastics oversold in a bull trend, that's making me think, hang on, maybe I need to start looking at getting in. Trend lines, moving averages, and all the things that you can do with moving averages. They can work as support levels, moving average crossovers, all that kind of thing. That's pretty much it, actually. I think that's all the indicators that I have on my chart. Very simple. I look at multiple time frames, like everyone does: hour, 4 hour, daily, and weekly, and even monthly. I need to remind myself to look at the monthly chart, but it's something that you really should focus on. You really need to see the bigger picture. When you were just talking about the yen, if you look at a lot of yen pairs right now, you go back 3 or 4 decades, we've had a major breakdown in the yen. And to me, from a technical perspective, it looks like the yen's going to collapse, and it has gone down significantly from where I said it had broken. And people were like, can it really keep going? The Bank of Japan won't let it fall that far. Well, it already has started. I mean, I don't know what the trigger could be, but it looks like the yen's in for a lot further to go when you look at a monthly chart. So that's kind of it. Yeah, and because I have my processes so well rehearsed, I've been doing it for so long, I can skim through 25, 30 markets pretty quickly. Problem at the moment is that there's so many Forex pairs that are trading in longer term sideways trends, and I really struggle with that. I think most people struggle with sideways. It's so much easier to trade a bull trend or a bear trend.
Yeah. You mentioned the yen. I think when I started working with a mentor this year, he was a very big macro guy and big on bullish yen, which macro would make sense, right? But I think sometimes the beauty in technical analysis is it does kind of write out all the opinions or quiet all the opinions of everyone and just watch his price action. And yeah, when yen hit, I don't know what it was, 155 or something, and then I heard people calling for 160 and dollar yen. And I was thinking, oh no, this can't be the way it works. I think this is the macro world. And then they just kept selling yen. And it was one of those times where it's just like, yeah,
exactly.
You have to listen to price. It's just gonna, that's just the way it's going. Right?
Yeah, as I say, you've got to keep your thoughts on the macro. But like beginning of the year, when inflation started strengthening in the UK, in the US, and people were like, "Oh, there won't be a rate cut. Rates might even have to go higher." Well, if you just stuck with the trend, the trend for for interest rates was the trend was it was going to reverse, and the dollar was weakening, and gold was continuing to go up, and the stock markets. I mean, I think the stock markets are insane. I don't know what they're doing up here, but you just can't argue with it. They're going up. Yeah. Just don't sell it.
Yeah. But it can be such an enticing case for someone that's new, because I guess when you're selling against the majority, it's kind of got that feeling of, I know something that the market doesn't know. And even if it's very unlikely you do, but even if you do, it doesn't matter. It's that classic market can stay irrational longer than you can stay solvent, and you're just going to lose your money. I know, because I tried to short equities, and now I almost have a golden rule to never short equities, because I think they go up. I think it's 7 out of 8 years equities go up or something crazy like that. So
I can't tell you how much money I've lost from trying to pick the top in the stock markets over the years. I stopped doing it a long time ago, but I just kept doing it. I just thought it's too expensive. It's too expensive. It's gone up so much. And this is one reason why I'm a trend follower now, because I've lost so much money by trying to trade against it. Yeah, it just doesn't work.
It definitely keeps you just on the right path, because I'm kind of a converted trend follower. I do hate the let's just follow the trend, guys, and not understand what's going on. That part of it does kind of irk me a little bit, but overall it doesn't. It's just focusing on what is happening right now, and not getting too detached on your own world in your head that this is the way things should work. It's like, this is the way they're working. Full stop. And so
yeah.
But you mentioned identifying bull and bear trends, right? So how do you, because we have multiple time frames, and you could be bullish on a 4-hour time frame, or we could be bearish on a monthly time frame. So how do you identify, say, a bull trend or a bear trend, and what kind of time frames do you use to do that?
For me, the time frame I think that I rely on most is the 4-hour. That works for me because I'm looking for trades where I can risk, as I say, about 25, 30 pips, try and make 50, 60, 80, 90 pips. So that suits that time frame. It does at the moment because markets are not that volatile. Sometimes the euro US dollar will move 30, 40 pips in a day. It's appalling. It's so difficult to make money now. I remember the days when it would always move 100 pips. So you could easily do an intraday trade, nick 60 pips, and not even catch the high and the low. You didn't need to. Nowadays, in order to do what I do, you have to run a lot of positions overnight. So anyway, for that reason, the 4-hour time frame works for me. If things got more volatile, and I hope they do soon, then I would probably focus more on the 1-hour chart. Because if you're moving 100 pips a day instead of 50 pips a day, then you only need your fib levels going back across an hourly chart in order to find trades where you can risk 25 to make 50. So basically, right now, the 4-hour chart is the one I go to.
And on the 4-hour chart, are there any specific moving averages you use to say when this crosses this, it's a bull trend, or price is above this and therefore it's a bull trend? Or how do you?
I have a very standard chart set up. So I have 50, 100, 200, and 500 moving averages, and that's because I look at 30 markets. So I have to have a one size fits all for every market. If I was to advise someone who's starting to trade, most traders shouldn't really be looking at more than 3, 4, 5 markets, and probably only really trading 3 at a time. It's just not necessary. On that note, actually, I would say focus on a small number of markets, but to practice your technical analysis while you're sitting there doing nothing, look at as many markets as you can. Throw your trend lines and your moving averages and your Fibonacci's on there, and just get used to looking at the price action and how trend lines work. But actually trading, you should focus on a smaller number. Now, because I look at so many markets, as I say, I need a one size fits all, so that's what I use. But if I was focusing on gold and the euro US dollar, for example, I would probably try and fine tune my moving averages a little bit better to the timeframes that I use, so that I would have the moving average mapping the price action a little bit closer.
Right. And do you wait for one? Do you wait for, say, the 100 or 50-day moving average to cross over a different moving average to know we're in a bull trend, or do you use kind of price relative to the moving averages? Or
I don't rely on moving averages as a trigger, as a signal so much. I would use them as a confirmation because they're a lagging indicator. So I'm trying to get in before the moving averages turn. So for that reason, well, I think Fibonacci's are amazing. In fact, if there was only one tool that I could use, I think it would probably be Fibonacci. As long as you can get a trend, a sustainable trend, a prevailing trend, then using Fibonacci's to identify support levels. I'm looking for areas of confluence, so I'm looking for Fibonacci's to combine with moving averages and trend lines and candle patterns and candle formations. But if I could only use one thing, I don't know why they work so well. They just have this spooky. I think it just shows there's such a mathematical element to the markets.
yeah, I mean, that was my next question, actually. Basically, if you had to pick a kind of ride or die technical analysis tool, what would it be? And right, it sounds like Fibonacci, but
good question.
I watched your demo with Etienne Crete, where you kind of went through how you drill down using Fibonacci, which is quite different to a lot of people. So can you explain a little bit how kind of you start from much higher time frames and then you go all the way down to find multiple confluences?
Yeah, simple. I don't know if I assume other people do this. I don't know, but I kind of figured this one out for myself. So I will go back as far as I can. I mean, if you really, really want to do what I'm saying properly, you have to go back a long way. So for example, if I was looking at gold bottomed around 20 years ago at something like $266, I think it was. And we've gone up ever since. So I would only do this if I was expecting a big correction to the downside. I would take my swing low there and swing high to where we are now, or close, whatever the all-time high for gold is, 240, whatever, 2,450 bucks, something like that. And then what I'm looking for is a swing low around the 61.8 once I put those Fibonacci levels on there. And you get it so often. It's really weird. When you get that, then I put the Fib levels on, and then I'll look at the 38.2 and I'll try and find another swing low around there. And I'll put my third set of Fibs on there, and I might even go to the 23.6. And I'll just keep doing that. I'll just keep breaking it down. And this gives you a fantastic roadmap for whatever market you're trading, of just levels. And if they tie in with the price action, which obviously you can see immediately, then I think to myself, okay, these are a reliable set of Fibonacci levels. And then if they also tie in with my moving averages and trend lines, then I've got trading levels in front of me. Dead simple. Now, sometimes they don't all line up, and that tells me, okay, this move isn't over. We're going to probably keep going before we get a correction, because the price is not lining up with the Fib levels. So there's further to go.
Yeah. And I mean, even when you describe it there, it sounds like you're building so much context around a move or a price chart, because when it's just nothing on it, sometimes you can kind of think, well, I mean, what's going on here? But once you start to have a look at moving averages over time, have a look at Fib levels, then you have some context. And as you said, a level that maybe you could even use to align with the longer time frame that has a bit of an edge. And then you have something. You have your scenario where you could potentially make money, at least, as you said, over 50%.
Yeah, because actually, see, people think, oh, Jason knows where the market's going to go. And I get people saying, where's gold going to go today? I'm long gold. What should I do? And I'm like, I have no idea. And if gold's in a bull trend, it'll probably go up, but I can't give you a time period for that. I don't have a crystal ball. I don't know where gold's going to be at 4 p.m. today. Just like Warren Buffett doesn't know where Apple stock is going to be in 3 months' time. He hasn't got a clue. He's not in Apple stock because he thinks it's going to a specific price in a specific period of time. So no, I don't know any better than anyone else. I can give you an educated guess on where the market could go today. But my strategy is all about finding areas of confluence which represent, for example, good areas of support in a bull trend. And that support might be 50, 70, 100 pips away from where we are now. I will put that on my trade sheet, knowing that we may never get there. But I know that if we do get there, I definitely want to try a long position there. That is just, I'm a trader. I'm looking for low risk trade opportunities. That is it. And I will put my bid in there and hope at some stage during the week we come down far enough for me to get in. Now, on my trade sheet every day, I could have 15 or 20 trade opportunities, and all I'm looking for is 3 or 4 of them to execute. And if 3 or 4 of them can execute, and 2/3 or 3/4 of those can turn a profit, I've had a terrific day. I don't actually want all 20 trades to execute, because that'd just be too much for me to manage.
Yeah, but some of these trades you put on, right, they are, as you call them, day trade ideas. But because you follow the trend, do you ever kind of add to those positions? If, say, you get a winning position in gold in the morning and hits your first profit target, do you ever think, because I've aligned to maybe the 4-hour trend or the daily trend, this could have legs and could continue on? Or do you kind of take your profit and look for the next one?
I tend to run things too far. I put targets on my spreadsheet for my subscribers, and I'll be honest with you, I tend to run the positions a bit further, because, as you say, I'm thinking I'm in a bull trend and I'm long. I'm lucky to be long at a good level in a bull trend. What am I getting out for? And I'll be honest with you, I often run things too far. I'm often too greedy, and I think it's a problem because I've been doing technical analysis for probably 20 years, and I've got nearly 40 years trading experience, and maybe I think I know more than I do, or I see things developing, but I don't, as I said earlier, I don't know how long it will take for them to develop. So I think gold's going to go to here, but I don't know if it's going to take a day, 2 days, or 2 weeks. And sometimes I'm holding on for that for too long, and then we trade into sideways consolidation, and I just think, oh, this isn't going to work, and I give up. So I really do suggest that you don't end up nursing positions for the sake of it. Set your target, be happy. If you've risked £1 and made £2, be happy and just look for the next opportunity. And the market might just come down to the next, might retest the support level. If it breaks above it, doesn't matter. You can say, okay, well, it's broken above. I'm now going to buy the breakout and go with it again. There are different options that you've got when you've closed the position.
Yeah, I think it's one of those softer kind of elements of trading, and when to take your foot off the gas and when to put your foot on the gas for. And as you've had 20 years experience in technical analysis, you kind of maybe even have a feel for this really could continue or not. But yeah, I agree that for newer traders, sometimes it's just about being satisfied with you following your process and hitting your first or second target, or even first target. You don't get the full way, but you followed your plan, and that was it. I think I had an issue initially where more was never enough. It was you hit your target, but what about the next target? And that was something I had to deal with, I guess, more personally, that you have to fix that, or you're just going to be you're just going to burn your account.
I think everybody does, and and as I say, I still do it.
Yeah.
But you're right. But you're right. I mean, it is, and this is something I teach. It's about the process. It's not about the money. Just keep ingraining good discipline, good habits. This is why I say you trade a demo account. People say, oh, but a demo account, it's not real money. It's not about the money. It's about becoming robotic and becoming, automating things in your brain, or making sure you automate as much of your trading as you can by identifying the entry point and having your stop loss and having targets. And that might be multiple targets. I'm all for scaling in across a range and having maybe 2 or 3 entry points and having 2 or 3 exit points that are different. I'm all for that. If you want to be greedy, get in at 3 levels, take profit on 2 of the levels, and then the third one, just run it. Just think, hey, you know what? I really think I'm right. I'm just going to shut my eyes. I'm only risking 1/3 of the position. I'm going to be in profit, and I'm in profit anyway. Trail the stop, and just why not just let it run? But at least you've bagged some profit, and then you're also moving on to another trade.
Yeah. And you pre-planned it, so you're kind of, your brain and greediness stays out of it. You've pre-planned your greed, so then when it happens, you're like, well, just following the plan, which is true. And I had maybe the opposite example where I was more fearful than greedy in positions, taking quick profits, and I just had to, say it at about 1 hour, take something off. Maybe it's 20% or 15% of the position. So it would satisfy my need to not move my stop loss every candle, and then basically get whipped out, and then price goes all the way down to where I wanted it to go in 2 weeks. So
yeah, that's absolutely perfect, and it's really good advice, because people think trading is stressful and you get anxiety when you're losing, and of course you do, because none of us want to lose money. But what some people forget is that anxiety starts kicking in really quickly when you're making money, because I've risked 100 quid and now I'm 150 quid in profit. That's a good sum of money, and I don't want to see that go back down to 40 quid. So your anxiety's kicking in. And then that's when you're watching and you're thinking, shall I get in? Shall I get out? Now I'm only up 90 quid, So that's why doing exactly what you said, scaling out, getting rid of a little bit, relieve that anxiety. Okay, I've taken some profit, but I think this trade's got legs. I'm going to run the rest. It's a really good strategy.
One thing I found with shorter term or faster kind of systems where you're opening, say for you, might be multiple trades in a day, that costs can rack up. As in just the spreads or transaction costs or whatever your broker fees are. Do you ever find that impacts your I guess results materially, or is it you just see it as a cost of maybe doing business?
I'm actually not that focused on it, and the reason is, I guess that's another reason why I'm more of a swing trader than a scalper, and I'm only looking to do 3 or 4 trades a day, because then that doesn't become too much of an impact. The costs, I don't really notice them, to be honest. I don't trade that big anymore, and I don't trade that often. To say, but I mean, I know some people come to me and they say, I've done 20 trades today. I'm like, okay, brilliant, but did you really need to do 20 trades?
Yeah, I think maybe it was more when I was intraday, or I guess again along that side quest that is looking for the secret to trading when you start, and intraday was just racking up fees, and I just felt like, it was, again, there are very profitable scalpers, but I think to give yourself the best chance, say swing trading is a great place to start, because it's that happy medium between not racking up loads of costs and fees and over maintenance of your charts and trading while you also have a job or a family, but doing the analysis, setting and forgetting, and then over time learning to manage the trade and deal with the anxieties that may come with the trade.
Yeah, you've actually brought up a really good point there, which I don't really think about. But yeah, the costs are an important point and really have to be considered. And of course, if you're running positions overnight as well, brokers charge you, whatever that overnight fee is. So all this you have to really take into account. It's a very good point.
Yeah, honestly, it's like no one ever markets with it. I think, no one starts their marketing with them on a Lamborghini talking about costs, trading costs. It's terrible marketing plan.
So true.
When I spoke to Rob Carver, who's like very systems focused, he was like, well, you can control your risk and you can control your costs. You can't control the outcome of your trade. And that's the first person I ever heard say, and this is only a few weeks ago. So it was on my mind, and I was thinking, I'm going to ask Jason this and see what he thinks.
Yeah, it's a good point, and I definitely haven't thought about it enough.
But I want to move to your business and working with clients and new traders, right? Because I mean, you must deal with quite a few new and experienced traders that come to you looking for signals or coaching or support. So when someone that's new comes to you, how do you kind of set them up for success in terms of expectations about what trading is?
Most of the people that come to me, I'm not a great marketer. It's only recently that I've started really stepping up my social media, so I'm getting more contact with people. And I believe I'm quite unique because I actually put all my contact details out there, so anyone can contact me. I've been told that not many people do that, but I actually quite enjoy that. And actually, I started doing that a few years ago, and it really was a good learning curve for me, because when you've done something for a long time, you just assume a lot of people know this and they know that. And then when you're talking to people, and of course, like I said earlier, they don't know what CPI means and how it can affect markets. They don't understand about inflation or unemployment. So that was, as I said earlier, one thing that I realized I actually need to start teaching. So I do that. And it also opened my eyes up to the psychological aspect of things, because when you're hearing about what new traders are going through, the whole FOMO thing, I think I went through it as well, but I probably wasn't quite so self-aware of it until I started talking to people and really hearing about their problems. And I was like, okay, yes, how do I find a solution for that? How do I find a hack for that to help people stop doing that? So a simple thing that I do is my entry point used to be really quite narrow, and people would say to me, oh, I keep getting in too early because I know you're probably going to be right, so I keep buying above your level.
Oh, wow.
So now I give a wider range of entry, like it could be 20 pips. I say scale in across that range, but don't get in above there. So there are little things by talking to people that I've refined. It's been quite very educational for me. But everyone has exactly the same problems. It's always FOMO, getting in too early, trading too large, revenge trading. It's all the things that we do. Over trading.
Yeah,
everyone does it.
Yeah, but because you're literally sending level and stop loss every morning, it should be impossible to do those things, right, for these people. But I guess some people probably still over trade, or as you said, still find a way to shift your level or kind of bring their own slant to it.
Well, people will sit in front of the screen and start doing other things. I mean, they may do other things that make money. I'm not judging, I'm not saying you should only do what I tell you. Other people can identify trade opportunities. I'm not the only person. So that's fine. But then I do get, I suppose the biggest problem, and this is why on my social media, I go on and on about stop losses, because it just stuns me how many people come to me and say, oh, I did this, I bought this, or I sold that, and now I'm in so much loss. What do I do? Where's it going to go next? And I don't know where it's going next. You absolutely have to know. This is key. You have to know where you have to have an exit strategy. If you don't have an exit strategy, you are not trading. You are purely gambling. You don't know you wouldn't get on a bicycle and not know whether the brakes don't work. You'd obviously make sure they work before you set off. So why would you get into a trade and not know where you're going to get out? And if you're doing that, you're gambling anyway, because the point is you're only trading if you have a strategy that you're adhering to. That's the whole point of trading, because you're trying to find an edge. Now, you don't know if that strategy is working until you've done, let's say, well, at least 10 trades and preferably 100 trades, because then you can say, okay, now, and you can only say after 100 trades whether your strategy is working and how to optimize it if you've actually stuck to it. You can't, if you do 100 trades and you've just been like, oh, I'll buy a bit of that, and I've lost too much money, I'll get out. But then you haven't got any data to analyze, because you've just been jumping in and out of trades. But if you've gone, right, my stop loss is this because of that, and my target is always this, and I always risk that compared to that, and I always trade in a bull trend or whatever it might be, and you have an entry criteria, and you should really have a checklist. I mean, I'm sure most good traders have a checklist for their trades. And then you can say, okay, I've done 100 trades. How have I done? Should I have a wider stop loss? Would I have a better win rate if I did that? Or am I getting out too early? Should I have more ambitious targets? Would that have worked on these 100 trades? Then you have something to optimize. But if you're just trading spontaneously and really just punting around, you're never going to make any progress.
Yeah, I think it's such a great point that funny things can happen when you don't have a stop loss and you go past your kind of, say, mental stop loss, and then you keep going past it. And then you start to say, well, this is a great price to buy it again, I guess. And then you just keep going, and then you end up with half of your account down in a week because you have no breaks. As you said, it was a great analogy, actually, getting on a bike with no brakes. It's like literally, you can't trust yourself to know, oh, I'm going to be sensible here and step in and close my risk. And then they come to someone like you and say, I'm down half my account, should I just hold it? And then you're like, no, you shouldn't. Right. So, but how do you, I guess, do you actively work with your clients in terms of, say when they're trading or following your strategy, say after 10 trades that they're monitoring their results, and then if they're saying they're having some issues or they have these problems, do you try and help them in the Telegram chat, or do you kind of have more of a hands-off approach where you're kind of level set it and then they kind of make their own progress?
No, I actually encourage people to talk to me. I quite like it. I've made loads of friends through this business. I enjoy that aspect of it. And, you know, as I said earlier, I'll be honest with you, I don't trade that often. So I do have time to talk to people when I'm not running around these villas solving problems. And I have a course, and in my course, I say, sign up for the course and you get free mentor sessions with me, as many as you need, as long into the future. If you call me up in 5 years' time and say, I'm struggling, I did your course, can you help me? I'll set up a free 30-minute mentor call. And you know what? So few people do it. I'm really surprised how few people actually want to talk to me. I don't know, maybe I'm not a very nice person, but and all my subscribers, I say, you know, if you need to talk to me, if you're having a problem, but people seem to just chug away and seem, I guess they're doing fine because they've stayed subscribing with me for years and they don't really bother me and they don't really ask me too many questions. So I guess they must have found a way to be profitable.
Yeah, maybe. But I think, you know, having a mentor is one of those things that if you've traded for a while or been unsuccessful trading, you realize how important it is at the time. I think that's a great resource for anyone to have, is have someone like you as a mentor for free, just to reach out to. Because when I spoke to someone else on a podcast, I'd said, you know, you can make very small mistakes on your own and edge very slightly in the moment, go off your process and go off what this should be about. And then you just end up in 6 months somewhere that you really shouldn't be. You know, you shouldn't be trading that way. And it all started because, you know, you went offline initially and no one kind of whacked you back into place, like get you back into your process or
So
doing
true.
things the way it should
Yeah. And getting them back in place can be such a simple process. I talk to people and I've heard it all, and I know I have an answer for anyone who's got a problem because I've just heard it all before. And I learned the hard way. All the things that you just said in that previous, what you just said previously, I've done it all. I've made all the mistakes. I didn't wake up one day or become this great trader just because I worked on LIFFE. When I started screen trading, it was such a big transition. I was absolutely hopeless. I lost 30 grand immediately of my own money. I thought, right, I have no idea what I'm doing. I made every mistake in the book over and over again. I'm not a natural trader. If that's the truth, I'm not. You know, there are gifted traders that just sit in front of the screen. You get them once in a blue moon, and they just bang. They just know what they're doing. That wasn't me. I've all these processes I have are through me being hopeless and making the same mistake over and over again.
Yeah, I mean, I wish there was an easier way, but the more time that goes on, the more I think sometimes there is that journey you have to go on where you have to make your own mistakes too. I mean, I wish I listened to people initially. I wish I did, but I mean, I could have spoke to you and I probably wouldn't have listened. I would have thought I knew this and that, and then you have to lose it maybe a little bit. Try and limit the losses initially, I think, is important because yeah. And if I mean, I've just bought a house, so I don't have 30 grand anymore, right? But if I was to lose, you know, a sum of money initially, if you can keep it kind of small and then realize you likely need a mentor after a few months, and then you haven't lost all your capital, you can sort of go again when you find someone and find the proper way, and then you can start to build properly.
Yeah, I mean, anything that you want to get good at in life, you need someone to teach you. You know, we all go to school and get taught history and geography and maths by a teacher. When we learn to drive a car, we all have driving lessons. You know, what do you know, my sons are trying to be a professional footballer, and he's getting pretty close, so it's quite exciting.
Wow.
And of course, he's coached every single day of the week. You know, even at this level, he's been training for 10 years. He's 18, but he still needs a coach. And when he turns professional, he'll still need to be coached every day. So what makes trading any different? And it's such a mental game that you know, I really do advise people. I mean, I'm happy to help, but find someone that you can relate to and that you can that understands you, and go and get some. It is the only shortcut. Talk to someone who's made all the mistakes.
Yeah, and it's one of those things. I'm not sure why trading specifically, people think that with no background or training that they can come in and, you know, roll the dice a few times and be successful, when there's so many people competing all the time versus, you know, institutions or prop traders, or everyone is competing, you know, and is in a negative sum game where I said you have costs. So, you know, net, the odds are completely against you, but still you think that for some reason. I'm talking to my younger self maybe here, as in my younger self, not that much younger, but a couple of years ago, where it's just like, just sit down and maybe you're not as good as you think and listen to someone that's been around for 35 years.
And that's why I say to people, do trade a demo account for 2 or 3 months. And no one really does. And because it is about learning processes, it's not about making money. Anyway, no, you've obviously got a lot of experience. I mean, you do really understand what you're talking about.
Thanks. Yeah, look, it's experience from making mistakes, I think, and starting the wrong way, and then finding people like yourself. I mean, I've only found you more recently, but people that have lived a life doing this. And when you start, you think maybe some of these people are kind of have these magical know everything skills, like you said in this call. I don't know where gold is going, and that's not really what it's about. But when you start, you think maybe that's what it's about. Jason has all the answers, and he's the man with the ball, and he's going to tell me where, when. And as you meet, say, people like yourself or other mentors and tutors that have lived a life in trading, you realize it's not like that. And then eventually you see behind the curtain a little bit, and you can make a little bit of progress over time, and then go on your own journey, which I think is what it's really about. Right.
Yeah. I mean, my strategy is dead simple. I know what I don't know.
Yeah. But we started this conversation talking about discipline and your discipline in your work life specifically. And I know lack of discipline is a big problem for newer traders. And it's one of those softer problems, right? It's kind of a behavioral problem. So with a new trader that came to you that has a lack of discipline or, kind of heavy fingers, so to speak, when putting in orders, not following processes, how would you start to help someone kind of be aware of that?
Okay, so the first thing I would say is all of us today are a sum of all our experiences. So if you want to be a better trader in a week, a month, a year, you have to start today. Build good habits, build good processes, because then in a month you'll be a product of that. You'll be, you'll do things that you should do that you're not doing now. Put it that way. So if you think of it like that, you think, right, I'm really going to be a better trader in a month if I set a stop loss, set a target, or whatever it is, I stick to a bull trend, or and then okay. So the other thing is over trading, which you mentioned, heavy finger. Well, I said when people come to me with that problem, I say, okay, you only really need to do 3 or 4 trades a day. If you can do 3 trades and 2 are winners and 1's losers, you've had a phenomenal day. Maybe you've made 100 pips. So say to yourself, it's like Warren Buffett says, when you're investing in something, imagine that the stock market is going to close tomorrow for 20 years or whatever he says. Would you be prepared to hold that stock for 20 years? I think that's really clever. And I would say to people, think about how many trades you should be doing a day. And if it's 3 or 4, then limit yourself to that and say, right, I'm only going to do 4 trades today. And then find the absolute 4 best opportunities you can and say, right, those are the best. There's 6 opportunities out there, but I'm just going to take the 4 best ones. And that's it. I'm not going to do anything else today because I'm only going to look at the 4-hour chart. I'm not going to look at the 15-minute chart, which is throwing up lots of trades. And that's it. I'm just going to do that. And when I've done my 4 trades, I'm done. And hopefully, at least, well, even if just 2 are winners, if you've got the right risk-reward ratio, you'll still come away with a profit. And as you've said earlier, have a stop loss, not just on your trade, but on the day, on the week, maybe even on the month. And also when you hit a target, okay, I've hit my target on the trade, I'm out. I've hit my target on the week or on the day, I'm out. If you've got a 100 pip target for the day, hit it, stop. Because, when you get greedy, when you get overconfident, that's usually when there's a big disaster just around the corner.
Yeah. I love that advice. I think it's brilliant. I think the product of you being a product of your current actions in the future is a great perspective to not go off track, because you're really taking away from your future success if you're making mistakes right now, right? So that's really great.
You're robbing yourself.
Yeah. Jason Sen, thank you so much It's been an absolute pleasure, and I really appreciate your time.
I've really enjoyed it. It's nice to meet you, Colin. Nice to had a really good chat. Thank you.